Hi there and welcome. My name is Jake Schoenfeld and I'm joined with my colleague Jonathan Rosner. We are with TritonPoint Wealth. And Jonathan, today I want to talk about two topics that are very important in the world of financial advising and portfolio management. And those are asset allocation and asset location. At a high level, can you tell us a little bit about those two and what they are?
Sure, absolutely. I'd start by saying that asset allocation is definitely more well known by the population. At its most basic sense, it's the mix of investments and the categories of investments that go into a portfolio. So, put more simply, you would have your stocks, your bonds, and your private market investments. Just taking a quick step back, here at TritonPoint Wealth, we like to take an endowment approach to investing. So rather than just relying on the 60-40 portfolio, strictly using fixed income securities and equities, we like to dive a little bit deeper into private markets to achieve superior risk-adjusted returns. So what used to be a 60-40 portfolio might be a 50-30-20 portfolio. But to get back to your question, asset allocation, in its most basic level, is the mix that you're putting together. And how we get to that mix, there are a variety of ways that we get there. Asset location, however, is a little less well known by the population and investors broadly. It's where we add a lot of value as investors in the way that we construct portfolios. Location, think about it this way. There are different types of accounts, some retirement accounts, some non-retirement accounts. Within retirement accounts, there's a Roth IRA, there's a traditional IRA, pre-tax dollars, and then there's taxable accounts, or a trust would also fall under that category. Each of those three buckets has a different tax treatment, and that sort of guides what investments we locate within each bucket. So again, asset allocation is the mix. Mm-hmm. Asset location is where we put things.
So to take a step back and kind of summarize, I think what you're saying is it's the placement for location, asset location. It is what investments you put in what accounts based on the client's or the household's goals and objectives, right?
Sure. So, generally speaking, we look to be as tax efficient as possible. Mm-hmm. That's really where asset location comes in. Gotcha. It's putting certain tax inefficient investments in accounts where it can be tax inefficient. Mm-hmm. Or conversely, tax efficient investments in a taxable account. Mm-hmm. So that you can save money on taxes.
Absolutely. So who doesn't want to save money on taxes, right?
Yeah, well, that's for sure. That's something that gets pointed out to us on a quarterly basis.
Yep, absolutely. So you touched on something about asset allocation, right, and determining the asset allocation. I think for viewers of the video, as you mentioned, you can find out or determine a client's asset allocation or a household's asset allocation in a number of different ways, right? The way, if you're a brand new client off the street, typically, as a client of TritonPoint Wealth, you would fill out what's called a client profile form or a client intake form, which talks about your income and your tax bracket, and then what your risk appetite is, right? How much volatility you're willing to take on in the portfolio, what your goals are for each account, whether it's income production or capital preservation, or if it's growth because you don't need to touch the money. All of that comes into play. It can also be determined if you don't know, and at the time you've never worked with a financial advisor before, you're new to investing. It can be determined through the building out of your financial plan of
sure.
How much risk do you need to take on to reach your retirement goals, your life goals, your legacy goals, right? And then finally, you can just look at, if you're working with an advisor and you've never filled out something like this, you can look at your existing account or a statement and see what is the mix of equities to fixed income investments to alternative investments and determine that blend. So there's a number of different ways, and no single asset allocation there's no one mold that fits everything for a client, right? And you can have different asset allocations both at the household level, so the grouping of all of your household accounts, or at a specific account level, right? Mm-hmm. One thing that we talk about a lot is the Roth IRA, right? For those clients and households that have Roth IRAs, we as advisors like to lean a little bit more into growth in the Roth IRA because it is a tax-free asset. And so, it is a great legacy tool as well from an IRA perspective, much better than a regular or rollover IRA being tax deferred. But the goal typically with those is to lean heavy into growth, to grow that account as much as possible.
Yep.
Jonathan, going back to your point on asset location, can you talk a little bit about, maybe we start with taxable accounts. What types of investments fit into taxable accounts really well from a tax efficiency standpoint?
Absolutely. So again, with taxable accounts, you're going to want to be as tax efficient as possible. So when, let's just say you've come up with an asset allocation target for your taxable dollars of 50% equities, 30% fixed income, and 20% private market investments.
So at a high level, I just want to jump in. That's a 70-30 allocation to what we would call risk versus non-risk assets, right? The equities and the alternative investments make up the 70% of what can be seen as typically riskier investments, and then the 30% could be seen as fixed income, cash, a blend of non-risk assets in a way. Am I thinking about that correctly?
I would push back a little bit and say that not all private market investments would be considered risk assets.
Okay.
They are not correlated to traditional asset classes like stocks and bonds. So the inherent diversification that you're getting from them, even if they are a little more high octane, doesn't necessarily increase the risk level of the overall portfolio. So yes, to a certain extent, you're isolating the fixed income, the very safe portion, in a 70-30, the way you described it. But I think if you were to just take zoom in a little bit closer, those private market investments are working for you in a different way.
So for clients of TritonPoint Wealth and clients or viewers that have other advisors, it sounds like what you're saying is if they have private market or alternative investments, we would say to think of those in their own bucket, if you will, from an asset allocation standpoint, for the most part.
Yeah, we'll go down the rabbit hole of private market investments shortly, because we do sort of bucket them into alpha generating, as in trying to achieve outsized returns, but also income oriented, which is important. And we get back to the asset location conversation, which we'll do right here. So again, back to the example of a taxable account. You're going to have some fixed income exposure for your typical investor. You can look across the spectrum of fixed income investments. At the end of the day, one of the most important considerations are how are those bonds taxed? So a good example of asset location would be to take your municipal bonds, which, let's say that we're in Maryland as we are right now, and I'm a Maryland resident. If I own a Maryland bond, I'm exempt from federal and state taxes. So there'd be absolutely no advantage for me to put that into my IRA or my Roth IRA, but to put it into my taxable account, get the income on a tax-free basis, that's extremely effective.
Right.
So similarly, you take the perspective of within the equity side of the ledger, do you want your dividend payers to be in your taxable account, or do you want to have more growth-oriented equities in your taxable account, or do you want to have mutual funds or individual stocks? At the end of the day, the more yield you're getting on an investment, the higher the dividend rate is. You're creating a taxable event.
Right. Because those dividends are taxed in a taxable account at ordinary income tax rates, right? So depending on what your tax bracket is, if you're earning W-2 or 1099 income every year, that plays a role into how much of it that you can keep at the end of the day after you pay your taxes, right?
That's exactly right. So if we pivot to an IRA as an example, let's just say it's a 60-year-old client that has a 60, well, we'll go back to the 50, 30, 20 mix. You're going to want to shelter the high income producers in that IRA. So where you're getting the most income, call it a corporate bond or or a taxable municipal bond, which does not have the same tax exemptions, you're going to want to house that income in the IRA so that it can compound, and you're not going to be paying taxes on the income. Which, as an aside, going back over to private markets, we utilize several private credit strategies. Those are going to have 10, 11% in current market environments for the rates, the yield that you're getting on those investments.
Yep.
You put that in a taxable account, you're going to be paying a lot of ordinary income on them.
Absolutely.
You put them in an IRA, you're not going to be paying any taxes on the income, and you can either let it go to cash to use for other purposes, or you can reinvest into the strategy and get that compounding in the IRA, sheltered from taxes. Very effective.
So just to recap here, right? Let's first touch on the taxable side. You talked about fixed income there, right? So, typically as we think about investing in asset location, if you have a client that says, "Hey, I want some stability, I want some income production, but I have taxable money," whether it's a joint, individual, trust account, whatever it might be. The first thing, one of the first places we would look for fixed income is individual bonds, not bond funds per se, but individual bonds, and defaulting to, if they're a Maryland resident, Virginia resident, whatever it might be, the municipality in which they live, to try and capture some of that tax efficient and tax free income from those bonds. Is that right?
That's exactly right.
And then jumping over to the retirement side, the IRAs, the tax deferred and the tax free with the Roth IRA. If you have a rollover IRA or a traditional IRA, you're saying that corporate bonds or taxable municipal bonds would be the way that we would go for a fixed income allocation within those, because those accounts, you're not taxed on the income that's produced. You're only taxed when you pull the money out of a rollover or a traditional IRA.
That's right.
Gotcha.
Absolutely.
So then, and you touched on the private credit and the alternatives being not tax efficient, right? How the tax treatment of the dividend from those private credit investments is ordinary income tax rates, right?
Yep.
So we tend to shelter them in an IRA, again, like we said, for the tax sheltering. Can you touch a little bit on private real estate? Because that's one that I think is a really tax efficient asset, especially for some of the investments that we use and how we leverage that.
Yeah, you took the thought right out of my brain before I could even go there, but that's why we work so well together. Finish each other's sentences. But so we do utilize private real estate for its tax efficiency in taxable accounts. You can get a very healthy income component, 4 to 5%, often with core strategies that we use. Mm-hmm. And the key consideration there is return on capital. The return of capital and the tax treatment of that income, because of the depreciation component in the properties, makes that income tax advantaged. Not tax free, but tax advantaged in the sense that you don't necessarily have to pay taxes on the dividends that you're receiving right then and there, but your cost basis is going to be lowered. Mm-hmm. But it does afford you the ability to get bond-like, better than bond income, and not have to pay ordinary income taxes on 100% of the income that the real estate's producing.
Absolutely. Staying within the realm of private markets, and you touched on two different buckets, right? Income production or alpha generation, right? Mm-hmm. Can we shift to the alpha generating strategies within private markets? And if you want to touch on, maybe say the equities too, if you have a second, can we shift to that?
Yeah. So for the when you look at private markets, just putting them into silos, you've got private credit as a core strategy. Mm-hmm. You have private equity, private real estate, hedge funds, and then co-investments, which can be a variety of things. It can be a credit co-investment, it can be a private equity investment. We'll expand more on private markets and the investment types in future meetings like this, but for the purposes of today, I touched on private credit as being effectively sheltered in traditional IRAs, mm-hmm. private real estate for your taxable accounts. What we haven't touched on really is private equity. Private equity strikes that nice balance. It's a tax efficient means of getting exposure to private markets. A little known tidbit here that's hopefully still relatively accurate is so there are 20,000 companies in the United States that have revenue annually in excess of $100 million. 20,000 is a pretty impressive number. The reality is 86% roughly of those companies are private. So unlocking that access to private equity investments can be extremely powerful and can be a growth generator for your portfolio. Mm-hmm. It's where you can add that alpha to the public market investments that are already in your portfolio through equities. You can get excess returns with good manager selection. Mm-hmm. Manager selection is paramount. But going down on a little bit of a tangent, with private equity, depending on the structure, you're not going to be getting a lot of ordinary income spinning off. You're going to get capital gains treatment. Mm-hmm. It's acceptable in a taxable account. Yeah. It's a good place to have it. Yeah. It's also great to have in your Roth. Yeah. If you can put private equity into your Roth IRA, which is the bucket that lasts the longest, it's the last one that you're going to touch, it's the one that you're going to use as a legacy tool, as you mentioned earlier, it's extremely impactful to have private equity sheltered there. And of course, within private equity, there are several subcategories: mm-hmm. buyout, venture, secondaries, primaries. Right now, I would say that the secondary market's very in vogue. We can get into more detail at a later date on what those are. Mm-hmm. But again, putting private equity in the Roth or the taxable account is a prime example of asset location.
Gotcha. So, just to summarize everything, and we touched on it earlier, right? When you think about the breakdown of how to put the puzzle together, right? You've determined what your asset allocation is, and now it's time to go to work, right? And it might be, like you said, where we're more aggressive with an asset allocation in a Roth IRA because it is typically the last asset. If you have a wide diversification of accounts to draw from, the last bucket that we look to draw from if we can, from a tax perspective. So it might be that you're more aggressive in the Roth IRA and more conservative on the taxable side of the balance sheet because, if you need to draw from the portfolio for an unknown expense that pops up or something like that, or you're treating it as your savings account, your rainy day fund, really it's just creating that balance between the registrations to get to that overall, whether it's a target asset allocation or a predetermined household asset allocation.
That's a great summary. I'd say that it's an art and a science. Mm-hmm. And I think it's important to go back to where we started at the beginning when you were articulating how do we get to the asset allocation. Mm-hmm. So we're very much believers of goals-based financial planning. Yep. And when we go through that process, we identify an asset allocation mix mm-hmm. that gets you to a target return or a family hurdle rate that you need in order to have a high probability of success to meet your goals. Yep. So that may dictate whether we're 80-20-20. That's not a real thing. 80, well, it is if you have an extension fund, but that's definitely something for another day. But just to go back, whether it's an 80-10-10 mix mm-hmm. or a 60-20-20 mix or a 50-30-20 mix, mm-hmm. hopefully all those add up to 100. That'll get us to that target rate of return. But like you said, when you're actually constructing the portfolio, that might mean that you're heavier on equities and risk assets in the Roth. Mm-hmm. That might mean that you're more conservative with the taxable dollars because that's the first bucket you're going to touch. And it's all about the time horizon. So that's where the art comes in. But we do use the goals-based planning to achieve that baseline asset allocation, and then it's up to us as practitioners to get in there and asset allocate or asset locate mm-hmm. appropriately.
And the time horizon is, I think, one thing to kind of close out here. What we set as the asset allocation for an account or for a family or a household at the beginning of the relationship is by no means the end all. It may be, right. It may just be that this is what you've determined is, and it continues to work. But as markets change, as the macroeconomic environment changes, as your household needs change, as your financial situation changes, the asset allocation is fluid. And the transition, whether it's by account or by household, as that asset allocation changes, we look to do as advisors here at TritonPoint in the most tax efficient manner when dealing with taxable money. Right?
Yeah, one thing we didn't even hone in on at this point is not so much an investment type, but more of an investment strategy as it relates to tax efficiency. So with taxable accounts, we like to use tax loss harvesting strategies.
Yep.
Not to go into too great of detail, but at its most basic level, as you know, you're buying the market essentially in individual securities, and as the markets fluctuate, stock A, which we'll call Coca-Cola today, might go down and you could sell it, capture a loss. Buy Pepsi, stock B, keep your sector exposures aligned, try to mimic the performance of the S&P 500 or the benchmark that you're striving for while being tax efficient. So that type of a strategy, obviously, only applicable to taxable accounts.
Right.
And similarly, we can do the same thing with fixed income now. Actively manage fixed income with municipal bonds. When rates go up, bond values go down, you have another opportunity to lock in some losses, mimic what would otherwise be a benchmark performance type of an experience, and accumulate those losses to offset future gains. Yeah. So while that doesn't necessarily align exactly with asset allocation or asset location, it's a tax efficiency practice that I think is, in the context of this whole conversation, is very important to recognize.
Because at the end of the day, like we stated earlier, it's not about what you make, it's about what you keep.
Yeah.
And taxes, unfortunately, play a huge part in that.
Yeah, absolutely.
So, Jonathan, thank you for joining me today. It's been a pleasure. As always, if you have any questions, feel free to reach out. You can reach us here at TritonPoint Wealth. Feel free to call us or send any emails. Thank you.
Thank you.